If you have spent any time looking at Singapore government support for businesses, you have almost certainly come across the Enterprise Financing Scheme, usually shortened to EFS, and there is a very good chance you quietly filed it in your head alongside grants like PSG and EDG. That is the single most important thing to unlearn today, because EFS is not a grant, it is a loan scheme. It is about money you borrow and pay back, not co-funding you get to keep. In the next few minutes, we will make that distinction crystal clear, walk through the different kinds of financing EFS brings together under one roof, explain the risk-sharing idea that makes the whole thing work, look at who it is broadly for and what you should prepare, and talk about how you actually approach it, all in plain English. One important note before we start: this channel is educational only. We are not a government agency. We are not affiliated with or endorsed by Enterprise Singapore or Go Business. We are not a bank, and we are not an approved vendor or consultant of anyone, and nothing here is official or financial advice. The rules, the figures, and the terms for EFS are set by the authorities and by the participating banks, and they change over time, so treat everything here as background, and always confirm the current details on the official sources, gobusiness.gov.sg and enterprisesg.gov.sg, and with the participating financial institutions. Before you act, what EFS is, let us define it plainly. The Enterprise Financing Scheme, or EFS, is a scheme in which the government works together with participating financial institutions, mainly banks and some finance companies, to help enterprises get access to financing. The government does not usually lend to you directly, and it does not hand you cash. Instead, it partners with lenders and takes on part of the risk when those lenders make loans to businesses. On top of that, EFS is not a single product. It is more like an umbrella that gathers several different types of loans together, each aimed at a different business need. So whenever you hear EFS, picture two things at once. First, a lender in the room with you, an application and repayment with interest. Second, the government standing behind that lender, making it a little safer for them to say yes. Hold on to both of those pictures because they explain almost everything about how the scheme behaves. A loan is not a grant. This is the distinction that trips people up the most, so let us slow down and get it right. A grant, like the ones we cover in other videos, is co-funding. The authorities pay a share of certain qualifying costs, and that money is not something you repay. It is support you keep in exchange for doing an approved kind of activity. A loan is the opposite arrangement. It is borrowed money. You receive a sum from a lender, you use it in your business, and then you pay it back over time, together with interest, whether or not the plans you had for it work out. EFS lives firmly on the loan side of that line. It can make borrowing more accessible, and that is genuinely valuable, but it never turns a loan into free money. If you remember nothing else from this video, remember this: a grant is money you do not pay back. A loan is money you do. EFS is about loans, a the financing it brings under one roof. Because EFS is an umbrella, it helps to know the broad kinds of need it is designed to cover, described conceptually rather than by any fixed figure. There is financing aimed at everyday working capital, the cash a business needs to keep operating between paying suppliers and getting paid by customers. There is financing for fixed assets, the bigger, longer-lived things like equipment or premises that the company invests in. There is trade financing, which supports the cash flow tied up in buying and selling goods, especially across borders. There is project financing for larger pieces of work a company takes on at home or overseas. There is support connected to mergers and acquisitions for companies looking to grow by combining with or buying another business. And there is venture debt, a form of borrowing oriented towards higher growth companies. The exact names, boundaries, and what each type covers are all defined officially and can be updated, so use this as a map of the terrain and confirm the current lineup on the official source. How the risk sharing works. Now the clever mechanism at the heart of it all. When a bank considers lending to a smaller enterprise, its biggest worry is default, the chance that the borrower cannot pay the loan back. That worry is often what makes a lender hesitate, especially with younger, smaller, or asset-light businesses. Under EFS, the government agrees to share part of that risk with the lender. In plain terms, if a supported loan goes bad, the government shoulders an agreed portion of the loss and the lender carries the rest. Because the lender's downside is reduced, it becomes more willing to extend financing to businesses it might otherwise have turned away. That is the whole point, and it is why the scheme can widen access to credit for SMEs. But there are two things you must keep straight. The risk sharing is an arrangement between the government and the lender, not a promise to you, and it does not reduce what you owe. You are still fully responsible for repaying your loan. The exact share the government takes on is set officially and has changed over time, so I will not put a number on it here. Who it is broadly for? So who is EFS broadly aimed at? In general terms, it is for enterprises that are registered and operating in Singapore with a genuine local element to the business that need financing either to run day-to-day or to grow. Because the umbrella holds several different loan types, different parts of it suit different sizes and stages of company, from an established firm buying equipment to a fast-growing one raising venture debt. The spirit of it is to help real, viable Singapore-based businesses reach financing they can sensibly use and service, rather than to prop up companies that cannot support borrowing. Beyond that broad shape, there are specific conditions, and they matter. The precise definitions of who is eligible, what counts as a local element, and what financial standing is expected are all set officially, and the lender will apply its own assessment on top. So take the shape of it from here and confirm the exact rules on gulfbusiness.gov.sg and enterprisesg.gov.sg. Because this is a loan through a financial institution, you should prepare the way you would for any serious borrowing, not the way you might dash off a quick grant claim. Start by getting clear on exactly what you need the money for and roughly how much, because a lender will always ask, and a vague answer weakens your case. Have your financial records in reasonable order, since the lender will want to understand the health of the business and its ability to service repayments. Think honestly about your cash flow and whether the business can comfortably carry the repayments alongside everything else. And be ready to explain the story behind the numbers, what the financing enables, and how it gets repaid. None of this is unusual. It is simply the groundwork of being a borrower a lender can say yes to, and the risk sharing behind EFS works best when you show up as a well-prepared applicant. Borrowing responsibly. Let us be honest for a moment, because this matters more than any feature of the scheme. EFS can make financing easier to obtain, but easier to obtain is not the same as free, and it is not the same as wise. Every loan is a commitment. You repay it with interest on a schedule, regardless of whether the plan you borrowed for actually pans out. The point of the risk sharing is to open a door, not to remove your responsibility for what happens after you walk through it, so borrow against a real need, not a hopeful one. Match the size and type of financing to what the business can genuinely support. Resist the temptation to take more simply because it is available. Good borrowing is deliberate and sized to reality, and the businesses that do best with schemes like this are the ones that treat debt with respect rather than as a windfall. How to approach it and apply. So how do you actually move forward? This is where EFS feels different from a grant. You do not simply apply on a government portal and wait for co-funding. Instead, you approach a participating financial institution because the loan itself comes from the lender and the government support sits behind it. The official information about the scheme and the participating lenders lives on the Enterprise Singapore site, and that is where you should start, rather than an old article or a forum. A sensible sequence looks like this. First, get clear on the financing need and the type that fits it. Second, read the official EFS pages so you understand the current loan types, conditions, and which financial institutions take part. Third, approach one or more of those participating lenders, discuss your situation, and compare what they offer. Fourth, apply through the lender and go through its assessment. I want to be very clear about one thing. We cannot secure, approve, or guarantee any loan for anyone, and no honest party can promise you an outcome. What you can do is prepare well and apply through the proper route, which is entirely in your hands. Quick recap. Let us pull it together. The Enterprise Financing Scheme, EFS, is not a grant. It is a loan scheme in which the government partners with participating financial institutions and shares part of the default risk on the loans they make to enterprises. Because the lender's risk is reduced, it becomes more willing to finance SMEs that might otherwise struggle to borrow. EFS is an umbrella covering several loan types, from working capital and fixed assets to trade financing, project financing, mergers and acquisitions, and venture debt. It is broadly for genuine Singapore-based businesses that need and can service financing you approach it through participating lenders rather than a grant portal, and you still repay every dollar with interest. And because the exact rates, amounts, shares, and criteria are set officially and by the banks, and they change over time, the live details always come from gobusiness.gov.sg, enterprisesg.gov.sg, and the financial institutions themselves. A closing reminder, remember the spirit of this channel. Our job is to hand you the map and the vocabulary so schemes like EFS stop feeling like alphabet soup, and you can walk into the official pages or into a conversation with a lender already knowing what you are looking at. But the official sources and the participating banks always have the final word. Nothing here is a promise that you qualify, that any loan will be approved, or that any term you heard is current. When you are ready, get clear on what you genuinely need to finance, read the official EFS pages on Enterprise Singapore, and talk to participating financial institutions from there. If this made EFS clearer, subscribe for a new Singapore grant breakdown, and we will keep turning these schemes into plain English one at a time, so you can make funding decisions with your eyes open.